Hi, it's an absolute pleasure to be here with you on your financial literacy journey for the next 90 minutes or so. My name is Jasmine Konsorada. I'm currently an assurance director at PwC. I've been with the firm for 16 years, leading complex, growing international audits for NPOs, private and public companies. I have significant experience in all facets of financial reporting, and I'm excited to share some of that knowledge with you today. Diversity and inclusion is a passion of mine, and I'm so proud of you in taking this step for your personal journey of directorship.
Hi everyone, my name is Adrienne and I'm a director in PwC's Deals practice. I'm a CPA by background and have spent several years in our assurance and financial due diligence practice. I now work with a team of specialists who advise clients on the financial aspects and pricing mechanisms of their sale and purchase agreements. I've been volunteering with Director Network since 2019, and I'm also the current board chair of Calgary Corporate Challenge. Really excited to be here and share some insights with you today.
Hi, my name is Abigail and I'm a manager in risk advisory at Deloitte. I'm a CPA by trade and just spent over 5 years as a financial statement auditor. I have had many NPO clients in Alberta that I really enjoyed working with. And now I'm more focused on helping my clients use technology and automation to mitigate risks in their business and accounting processes. I'm also a director and treasurer of SheetGeek, which is an organization based out of Calgary that aims to build gender diversity in technology.
We recognize that financial literacy can create a barrier to board service. To help dismantle that barrier, in this course, we're going to cover some of the main pillars of financial literacy, especially to support non-accountant directors. Here's an overview of our agenda. We'll start off by taking a look at board governance from a financial perspective. We'll look at common financial roles and responsibilities and provide you with an introduction to financial policies. Next, we'll get into financial reporting considerations for NPOs, specifically the key objectives to keep in mind, as well as some unique aspects of NPO accounting. In our third section, we'll go through some practical ways to approach financial analysis and budgeting. If you've taken DirectHer's Board Basics course, and we recommend that you do, you know the board acts as the ultimate decision makers of an organization. Think of it as its brain. Because the board has decision-making authority over an organization's assets, the directors on the board have a fiduciary duty, which means that they have a legal duty to act honestly and in the best interest of the organization. When we think about how directors fulfill their fiduciary duty, we generally think of 3 main areas: performance oversight, risk management, and strategy. So how does the board perform these functions in a financial perspective? 3 common ways are by reviewing and approving financial statements, by identifying the need for and potentially developing financial controls. These can be policies or processes, and by shaping and approving a budget. Let's take a further look at how these activities are related to a board's role. When boards review and approve past financial statements, they can explore risks and opportunities presented by past financial performance. This enables them to determine if past performance demands change, whether that's in strategy, in acceptable risk levels, or in the CEO. When boards identify the need for financial controls, they define the level of risk that is acceptable within the organization and ensure there are processes to maintain it. And when boards approve a budget, they are ensuring future spending choices are aligned with the organization's strategy and priorities. In Board Basics, we talk about how boards commonly delegate things. On the last slide, you may have picked up that delegation was happening. In that example, the board was not preparing the financial statements, but reviewing them. This is common and a good idea because of something we talk about a little bit later called segregation of duties. The board can delegate this type of operational work to anyone, but commonly the preparation of financial statements will be delegated to a chief financial officer, or in some not-for-profits, a role called the treasurer. That said, remember, accountability flows up, which is why it's important for the board to have a role in reviewing and approving these types of statements. Speaking of the treasurer, this is a role which, when used, is used in a myriad of different ways. This results in a lot of confusion sometimes. So depending on how the board defines this role, a treasurer, they may or may not be a board member, and they may or may not be doing operational work, governance work, or both. One thing that is true, regardless of how the role is defined, is that a treasurer is an officer. This means that the board appoints and defines this role, and that the person is also a fiduciary to the organization. We have seen a few ways treasurers are commonly defined. The first definition is that of the bookkeeper. This type of treasurer is expected to carry out all financial roles of the organization, including banking, processing accounting entries, preparing financial statements, and budgets. In best practice, this type of treasurer would not also be a director, given their direct involvement in operations. But if someone is this type of treasurer and is a director, consider how they can best wear both hats. For example, can a board implement a process where the treasurer is not reviewing, overseeing, or approving their work? For example, many years ago, I was the president of a business students association. The VP Finance was director and also the treasurer. This person managed all the bookkeeping, donations, bank accounts, and prepared the financial statements and the budgets. While we had others on the board for dual signatures and presentation of financials, he was solely responsible for all financial tasks. Next, we have the financial lead. This type of treasurer is similar to a chief financial officer in a for-profit company, someone who is leading or directing a group of people to fulfill the accounting and finance function. This type of treasurer is still very focused on the doing, but because of the additional support, they may find it easier to mentally separate when it comes to risk, performance oversight, and strategy. However, the same question still remains. Can this type of treasurer do both operational and governing work? And what processes need to be in place to enable this? Next, we have the oversight lead. In this situation, the treasurer is no longer completing the operational accounting work, but is assuming to be leading the financial oversight of the organization, including overseeing the annual audit or shaping financial controls and policies. Most commonly, this type of treasurer is only on the board and may be operating akin to what others call the chair of the finance committee. While this role has separation of governing and operational work, it may create a new risk that the board defers or delegates all financial risk management and oversight to this person. This type of treasurer has to ensure that the board continues to realize its collective role in these functions. I often see this structure on larger not-for-profits like the United Way or foundations who are able to leverage another organization's accounting and finance team. And last, the treasurer may be expected to do all of the above, which is usually a sign that the role hasn't been defined or thought through. The point with all of this is to emphasize the need for role clarity. If your board operates with a treasurer or you are being asked to become one, consider the following questions. Is the treasurer reporting to themselves? Is there a way to divide the preparation and review, approval, or oversight of financial information? And one final point on this. Remember, in the words of Brené Brown, clear is kind. It's best to have a written description of the treasurer's role. This could happen in a terms of reference document or through financial policy. Just ensure everyone is on the same page as to where the role is fully described. This brings us to the concept of committees. In Board Basics, you learn that committees are focused work groups who perform a part of the board's work that requires more time and attention. Often committees provide recommendations to the board and expedite its decision-making process. Common governance level committees that have a financial element may include the finance, audit, or investment committees. Typically, these committees are charged with helping the board to make financial decisions, such as approving the financial statements and budgets, or figuring out how best to maintain an organization's funds. These functions may be separate or all within one committee. Remember, you don't necessarily have to be a board member to sit on a board committee, including these financially focused committees. If you do join a board and have the opportunity to also sit on the finance committee, it can be one of the fastest ways to learn about the organization. So consider doing this, even if you aren't from an accounting background. If the thought of this scares you, recognize that your ability to ask simple, non-technical questions can be a very useful tool in testing financial information and processes. Now let's talk about a common tool boards use in filling their risk management role: developing financial policies. Financial policies are a set of rules that help a board to protect the organization's assets. These policies ensure staff and management understand what is acceptable behavior when it comes to handling and using assets. Financial policies help to mitigate risk around an organization's assets through something called segregation of duties, meaning that different people perform different steps in a process. Typically, this involves 3 functions: record keeping of assets, physical custody, and third, authorization to use the assets. To demonstrate the idea of segregation of duties, let's consider a very common risk area in the NPO world: the handling of cash. Without direction, a sole individual may be in charge of all aspects of receiving, recording, and reconciling cash. This can create a risk for unintentional or intentional mishandling. As a result, the board may develop a policy that segregates the duties, requiring, say, person 1 to collect cash and record how much was received in a ledger, the record-keeping function; person 2, who has access to the banking information, to take the cash from person 1 and deposit that into the bank, the physical custody function; and person 3 to review the cash deposit receipt from the bank account and reconcile it to the cash recorded in the ledger by person 1 to make sure that there are no differences, the authorization function. In some situations, it may not be possible to achieve segregation of duties. This is especially the case for many small organizations. In these situations, it's important for the board to consider some sort of controls to mitigate the most significant risks. It's also important to recognize that there is no one list of policies that will work for every board. This is because a board has to determine what risks it wants to define and what risks it is comfortable delegating. For example, in this cash handling situation, the board may require segregation of duties to be implemented through policy, but delegate the choice in how it's done to management. In addition to cash management, the board may want to consider developing policy as it relates to authorizations, expense approvals, asset protection, and financial reporting. For each of these areas, a helpful starting place is always to ask, what is the segregation of duties? However, when it comes to policy development, there may be considerations beyond segregation of duties. For example, if we were to look at asset protection, the board may first think to develop policy around access to physical inventory, defining where it will be kept, who has a key, or who can access it. This is a segregation of duties issue. But asset protection could also apply to the protection of customer data. This is less of a segregation of duties risk, but an important one with potential financial and reputational risk. As a result, a board may choose to develop a policy that dictates how data will be handled. Alternatively, they may delegate to management that a policy be developed that manages data risk within certain parameters. Implementing policies, financial or otherwise, is a valuable practice for any organization, no matter how small or large. But before adopting a policy, it's important to think about a few key things. As we've alluded to, start by asking, what's the board's role? Many financial policies are at a high enough level of risk to make the board's involvement appropriate, but with any policy, it's a helpful task to ask, is this our job, or is this more appropriately led by another party with input or review from the board? Next, where the board is leading the development of a policy, it's important that it has all the necessary information to do so. To gather this information, an assessment may need to be conducted to consider the operational risks around certain processes. So thinking back to the cash handling example, we would need to understand what key activities need to be done as part of the cash process and who is all involved. As part of this process, it can be helpful to get feedback from the treasurer or key operational staff members. These individuals often have important insights into areas where a policy may be needed. Once a policy is developed, it is important to ensure that there is a process for implementation to ensure everyone in the organization is familiar with the policy and following it. The board may not be in charge of developing the process, depending on the subject matter, but it needs to make sure there is one. Last, there should be a formal process to ensure that policies are reviewed on a regular basis. This could be done once a year or whenever there are significant changes to staff composition. It is important to continually reassess the policies to ensure they are evolving with any organizational needs. To close, in the words of DirectHer Network's own Bailey Rivard, trust is not a control. Bailey is one of our accounting team members and is an experienced forensic and investigative accountant. She has seen many times how this can go wrong, as have I. So while trust is critical to inspiring good governance, it in itself is not a financial control.
When it comes to the not-for-profit sector, there are some unique accounting aspects that need to be considered from a financial reporting perspective. In this section, we'll walk through some of these areas so you have comfort in what you're reviewing and approving as a director. One of the key components of financial reporting are the financial statements. Financial statements are designed to tell us three things. First, what an organization owns and owes. This is called the statement of financial position or the balance sheet. Second, how an organization makes and spends its money. This is called the statement of operations or the income statement. And third, how an organization uses its cash. This is called the statement of cash flows. You might be wondering, what's the difference between the income statement and the cash flow? We will get to that a bit later when we talk about accrual accounting versus cash accounting. For a director, financial statements are important because they can help you understand the story of an organization. Knowing the story will help you assess the performance of the organization and assess the performance of the executive director, as well as enable you to proactively assess risks and potential opportunities. In the next few slides, we're going to go through a sample set of financial statements. Our goal isn't to go in depth in analyzing these statements, but to provide you with some helpful points you can think of each time. First, we have the statement of financial position. So let's take a look at the dates. In this example, we have two different dates. The most recent period end, June 30th, 20X2, and the previous financial year end, December 31, 20X1. One of the most important things to understand is that the statement of financial position shows what an organization owes and owns at a specific point in time. One way to think about this is a snapshot. So if you live in Canada like we do, and you take a picture in December, that photo will look very different 6 months later in June. You can apply the same analogy to the statement of financial position. In the two comparison columns, you're seeing different snapshots or photos of an organization at certain dates, which helps you to compare how an organization has changed between those two dates. From a board's perspective, understanding the story of what an organization owns and owes is an important part of risk management and performance oversight. For example, you can ask, does it make sense that our payables, or the amounts that we owe, are increasing? Or if you see a large decrease in cash, do you understand how that will impact the strategic choices of the organization? So that brings us to the next point. How can we tell what the organization owns versus what the organization owes? Let's zoom in and take a look at the key sections to be aware of. The top part of the statement of financial position outlines an organization's assets, being what it owns. Usually assets are presented in order of liquidity, meaning what is easiest to convert to cash to what is least. So current assets, located on the top, are typically those that can be converted to cash within a year. Non-current assets, located on the bottom, are items to be used for more than a year. In this case, that includes costumes and props, but can also include things like office equipment. Moving down to the bottom portion of this statement, we see liabilities, so what an organization owes. And second, fund balances. This is the residual interest in a not-for-profit's assets after deducting the liabilities, and is the not-for-profit's equivalent to shareholders' equity. Within liabilities, you will see the line deferred revenue in the amount of $10,000. We want to talk about deferred revenue specifically because 1, it may be confusing why revenue can be a liability, and 2, it shows a really important lesson about understanding the cycle of your organization's finances. Grants are a popular source of revenue in the NPO world, and they often come with a certain stipulation about how they can be used. When it comes to recording these grants, in accounting, there are rules that an organization cannot record revenue until they've performed the service to earn it. Because the organization has an obligation to perform a service in the future, the grant gets recorded as a liability on the statement of financial position. So to illustrate, here's a high-level example. An organization receives a grant for $15,000 in March. The donor has stipulations that the grant can be used to fund operations for a 12-month period. So therefore, the organization cannot record the full amount of $15,000 when they receive it in March. They will need to recognize it over a 12-month period instead. So in this example, the organization would prorate the grant by taking the $15,000, dividing it by 12 months, which is $1,250 a month. So as of June 30th, 20X2, the organization has had 4 months of operations pass since they received the grant. Therefore, they can record 4 months of grant revenue, which is a total of $5,000. Because there are still 8 months of operations that the grant has to cover, the remaining portion, valued at $10,000, is considered unearned and shows up as the deferred revenue line under liabilities. If you fast forward to the end of the fiscal year, there would only be 2 months of the grant left, or $2,500. This would be unearned and recorded as a liability at that point in time. It's important to keep an eye on the deferred revenue, especially in the situation that an organization has an obligation to perform a service for a third party. For example, think about an organization that receives government funding to provide meals to low-income schools for a 12-month period. In this situation, it would be really important that the organization is properly managing their resources to ensure they can deliver on those meals. NPOs have 2 options for methods of revenue recognition: deferral method and restricted fund. Without going into too much detail, this may affect the timing of when revenue is earned and deferred, but we'll go into that in more detail a bit later in the presentation. This brings us to another very important thing to understand about the statement of financial position, or the balance sheet. The reason why it's called the balance sheet is because it should always balance, meaning the top part, the total assets, should always equal the bottom part, the liabilities and fund balances. So if you're ever looking at a set of financial statements where this is not the case, it's a really important question to ask. Now let's look at the statement of operations, otherwise known as an income statement. While the statement of financial position shows us a snapshot at a point in time, the statement of operation tells us how an organization made or spent its money over a period of time. This is usually over a fiscal year or a 12-month period, but it could be different, especially if the board is meeting quarterly and looking at quarterly financial statements. Again, I want to start off by drawing your attention to the dates in our example. In the first column, we have the 6-month period ended June 30th, 20X2, while the second column shows us the full 12-month period for the year ended December 31st, 20X1. This is important to remember in case you are trying to understand why things look different between the 2 columns, like the rent expense. Remember, we are comparing 6 months to a full year, so it's not really comparing apples to apples. So when comparing between periods, it's really important to be mindful of the time frame that you're looking at. The statement of operations tends to be broken down into 2 main sections. Revenues, how an organization makes its money, and expenses, how an organization spends its money. At the bottom, we have this line called excess of revenue over expenses. Here we can see a positive amount, which means the organization earned more money than it spent each period, which is generally a good thing. Depending on when you are reviewing financial statements, sometimes an organization might be spending more money than it's earning. For example, you could be looking at a set of financial statements for a 6-month period where a significant fundraising event hasn't happened yet, and as a result, this number may be negative. This isn't necessarily concerning. And as a director, part of your job is to understand why this is the case and consider the financial cycle of your organization. Looking at the very bottom line, the ending fund balance shows us the sum of all the money that an organization has accumulated over its entire history. This may also be called net assets. If you're more familiar with a for-profit company, this would be the equivalent of your retained earnings. While the goal of a not-for-profit is not to boost profits every year, it is important to make sure there's enough money to advance the mission into the future. Having a positive fund balance will help accomplish that. However, if the organization is holding large amounts of cash, consider what the implications could be. Different regulations may be concerned with costs being reasonable or relatively proportionate to the amount of money that has been raised. Last, let's take a look at the statement of cash flows. This statement is broken down into three main sections: operating, financing, and investing. Operating activities shows the actual cash that an organization receives in positive numbers or spends in negative numbers as part of operating. So in our example, the organization had positive operating cash of $11,000 at the end of June 30th, 20X2, meaning it generated enough cash from things like grant revenue and fundraising ticket sales and donations to cover its day-to-day expenses, such as rent, payroll, and office and marketing costs. If the organization is not generating enough cash from operations to cover its normal business costs, it may choose to take out a loan or borrow money, which would show up here under financing activities. In our example, the organization has nothing recorded here because it generates enough cash from its operations. This last section shows investments that the organization is making in non-current assets. So here, the organization spent $200 to purchase costumes and props during the period. This is a negative number because it's a cash outflow. If they had sold some props to generate cash, this would be a cash inflow or a positive number. At the bottom, we see the change in cash from the beginning of the period to the end of the period. So all of the financial statements are supposed to work together to tell you the story of an organization. So just like the balance sheet should always balance, the ending cash in the statement of cash flows should always tie back to the cash balance on the statement of financial position. Again, if you're looking at a set of financials that doesn't have this, it's important to ask the question. As a director, you are often tasked with reviewing the entire set of financial statements for an organization. While it's important to understand the entire story and how it ties together, everything ultimately boils down to cash, especially in the not-for-profit world. Knowing how much cash an organization has can give you the flexibility to be strategic and make decisions for the future. On that note, an organization will have several different stakeholders who will rely on the financial statements to make decisions. In this slide, we've highlighted just a few of the different types of internal and external stakeholders. It's important to keep in mind that each type of stakeholder will play a different role to the organization and will therefore use the financial statements in a different way. From an internal perspective, the main purpose of financial reporting is to maintain accounting records, budget for the future, and assess how effectively an organization is able to meet its goals and objectives. From an external perspective, financial reporting is an important tool for not-for-profits to obtain financial support. It's very common for donors to ask to see 2 years of financial statements before they extend funding. And many donors, including the general public, want to be sure that money they are donating is actually going to support the cause of the organization. Some stakeholders, like investors or creditors, may request that a professional accountant, or a CPA, be involved with preparing the annual financial statements. The level of involvement can vary, but is typically one of 3 types of engagements: an audit, a review, or a compilation, which is sometimes called a notice to reader. In an audit, the accountant will provide stakeholders the highest level of assurance that the financial statements are not materially misstated by performing detailed testing, such as an inventory count. So for example, at the end of the year, an auditor of Lululemon will go to some of the store locations to do test counts. They will physically count things like yoga pants and sports bras to make sure that what is in the store matches what's recorded in the system. You can imagine that this takes a lot of time, so the downside of an audit is that it can be time-consuming and costly. In a review, the accountant will provide some, but limited assurance to stakeholders about the financial statements. The intent of a review is to make sure that the financial information is plausible. So instead of doing a physical inventory count at the store, the accountant might only review the accounting records, compare the balance to prior years, and look at inventory ratios and ask about any significant differences. Because a review requires significantly less time and cost, it also provides a low level of assurance compared to an audit. In a compilation, also known as a notice to reader, the accounting practitioner provides no assurance to stakeholders. The practitioner assists the organization in the preparation of the compiled financial information. The practitioner should be knowledgeable of the organization and accounting policies to ensure the financial statements do not appear misleading. However, no detailed testing is done over the quality of information provided, and therefore the accounting practitioner provides no assurance. You may be wondering why an organization would seek a compilation compared to an audit or review. In the case where a not-for-profit does not have the internal capacity to create professional-looking financial statements, a compilation can help accomplish that. Sometimes just having financial statements that are formatted in a standard manner means that they can be easily reviewed by a third party, like a bank, and therefore a compilation would be a very cost-effective option for an organization. So again, the level of engagement that an organization needs will vary depending on the ask of its stakeholders. With that being said, we do want to draw attention to reporting requirements for not-for-profits that are incorporated under the Canadian Not-for-Profit Act. Due to increased scrutiny on the use of public sources of funds, for example, grants or financial assistance from the government, this legislation classifies any not-for-profits who have received more than $10,000 of public funding in one fiscal year as soliciting corporations. Soliciting corporations are required to have either an audit or review done, depending on their revenue levels, as part of their annual filings to the government. If you think about it, $10,000 isn't a lot of money, but this act requires an increased level of transparency and accountability for public funds.
When choosing how to prepare and report an organization's financial information, the first decision to be made is what basis of accounting is going to be used. When we refer to basis of accounting, we're referring to how an organization will record the transactions for the money that it earns and the money that it spends. There are two methods that could be used, the cash basis and accrual basis. The key difference between those two methods is the timing of when revenue and expenses are recorded. Under the cash basis, an organization recognizes its revenue when cash is received and expenses when bills are paid. In comparison, under the accrual basis, revenue is recognized when it is earned, and expenses are recognized when the bill is incurred. This is irrespective of when cash is received and paid. At first glance, the cash basis of accounting tends to be simpler and follows the flow of physical cash receipts and payments. However, it does not show a true picture of what an organization owns or owes at any given time. So to illustrate this, we'll walk through a very high-level example. A math tutor charges her student a fee of $30 per month for lessons over the 4-month period from January to April. On April 30th, the student pays the tutor a lump sum of $120. How should the revenue be recorded under the two methods? Under the cash basis, the math tutor would only record revenue when she received the cash payment in April. As you can see in the chart, she would not record any revenue in January, February, or March, even though she was actually providing the services during those months. All of her revenue would be recognized in April when she received the cash. Under accrual accounting, the math tutor would recognize the revenue over the period that she was tutoring the student. Because she was providing tutoring services from January to April, she can prorate the $120 over the 4 months, recognizing $30 per month. At the end of April, you can see that the total amount of revenue that she recorded is also $120. So if we compare the two methods, we can see that the total revenue under both methods is $120. So why does this matter? Imagine the tutor wanted to get a bank loan, and in doing so, the bank could ask to see how much revenue she made for the quarter ended March 31st. Under the cash method, she would have no reported revenue. The bank may turn her down because of this. Under the accrual method, she would have $90 of revenue that she earned over the 3-month period, which is a more accurate picture of the actual situation. Given our example, let's compare the pros and cons of cash and accrual basis accounting. While cash basis accounting tends to be easier, it doesn't show you the full picture of an organization's financial state. There are also restrictions in using cash accounting. Many external stakeholders will want to see audited or reviewed financial statements, but because cash accounting is not accepted under GAAP, which is a term we'll describe shortly, auditors will not sign off on cash basis financial statements. Therefore, an organization wants an audit or review to be performed. They may need to have accrual basis financial statements. The downside of accrual accounting is that it requires organizations to track things like receivables and payables, and therefore tends to be more time-consuming and complex. Because of this, it can be quite an exercise to switch from cash to accrual basis. While some organizations may not have the in-house expertise to start off with accrual accounting, it is important to consider what sort of financial reporting requirements they may need to have in the future. Going back to the term GAAP, GAAP stands for Generally Accepted Accounting Principles, and are standards established by an accounting regulatory body which outlines how organizations are to prepare their financial statements. GAAP establishes a consistent approach so that financial statements from different organizations in different industries and sizes can be easily understood and compared. GAAP also establishes guidelines and ethical standards so that companies can't make up certain calculations to report misleading financial information to their stakeholders. Similar to how different countries have different laws, there are actually many different types of GAAPs that govern financial reporting in different jurisdictions. Today, we're going to focus on something called Accounting Standards for Not-for-Profit Organizations, which is a Canadian standard specific for not-for-profits. So just whenever we're referencing GAAP in this presentation, just know that we're talking about ASNPO. Not-for-profit organizations heavily rely on contributions from donors to operate, most commonly in the form of cash donations, which is our focus area today. Contributions can come in many forms, but some of the most common ones are unrestricted contributions, which are amounts that may be used for any legal purpose appropriate for the organization, restricted contributions, which are amounts that are subject to stipulations that specify the purpose for which the funds are to be used. And so it's important to note that restrictions can be externally imposed or imposed internally by management. And lastly, endowment contributions, which are amounts that can be used as an investment where the principal amount is invested and only the income it generates can be spent. Under accrual accounting, or ASNPO, there are two different methods to report these contributions, being the restricted fund method and the deferral method. The purpose of today's session isn't to get into all of the detailed accounting for these methods, but there are some key differences that we wanted to highlight. One of the key differences between the two methods is how the financial statements are presented. Under the restricted fund method, restricted contributions are recorded in a restricted fund, which is kept separate from the rest of the organization. Restricted amounts are often presented in their own column in the financial statements. So this is quite different compared to the deferral method. Under the deferral method, there are no separate funds or columns. Everything is included in one total amount. To give you an idea of how the presentation looks under the two methods, let's look at the statement of financial position, or balance sheet, for two large not-for-profits, the Calgary Zoo and the Heart and Stroke Foundation of Canada. If we look first at the Calgary Zoo, we can see that they are using the restricted fund method. The statement of financial position shows different funds which are presented in separate columns. And if you add these columns together, you get to the total amount. In comparison, the Heart and Stroke Foundation uses the deferral method. This method may look more familiar to you. You can see that they only have one column, being the total amount, and contributions are shown under net assets. Both examples show us the organization's contributions. It's just a different way of presenting the information. When it comes to deciding which method to use, one consideration is, what do stakeholders need to know? If an organization has one key fundraising event that is vital to their mission, it may choose to use the restricted fund method so that donors can easily see the funds or contributions specific to that event with a clear separation from general operating funds. On the flip side, sometimes an organization will receive a large number of small donations for a variety of uses. In those situations, it may not be practical to use the restricted fund method, as they would need to present many different columns, which may distract from the overall financial picture of the organization. So this is where the deferral method may be preferred, with details about the various contributions and uses being made available through the note disclosures instead. Regardless of which method is used, it's typically best practice to read the note disclosures to any set of financial statements, as they will help to explain the story behind the numbers. It can also be useful to look at an organization's mission statement to identify any sort of reporting considerations for key stakeholders. So if we look at the Calgary Zoo's mission, we can see that as part of becoming Canada's leader in wildlife conservation, they operate a Centre for Conservation Research. And because this centre is a key factor to the zoo's mission, it is important that they show their stakeholders how resources are being used for this centre. The restricted fund method helps them to accomplish this. Here, they can clearly report the conservation funds separately from their other funds. Looking at the Heart and Strokes mission, we can see that it's more broad: promote health, save lives, and enhance recovery. This statement does not identify any specific activities that would be a key fundraising factor for the organization. If the Heart and Stroke does not have a lot of donors with restrictions, then it probably is easier for them to use the deferral method instead. Another key difference between the restricted fund method and the deferral method is how an organization records their externally restricted contributions. If we look at the Heart and Strokes contributions, we can see that they have unrestricted, internally restricted, and endowment contributions reported. But you may notice that reference to externally restricted contributions is missing. Does that mean that they have none? Not necessarily. Under the restricted fund method, when an externally restricted contribution is received, the full amount can be recorded as revenue in the statement of operations. So this is because the contribution can be tracked on its own restricted fund. Hence, users of the financial statements can clearly see the full amount that is restricted and kept separate from everything else. Under the deferral method, everything is shown in one total column, so it would be misleading for an organization to record the externally restricted contributions as revenue. Technically, this money is not fully theirs because they have an obligation to spend the funds in accordance with the donor's terms. And because they have an obligation, this creates a liability, which is recorded on the statement of financial position instead. Only when the organization spends the funds according to the donor's terms can they record revenue and reduce the liability. So under this method, revenue gets deferred to the statement of financial position and gets slowly recognized into revenue as the funds are spent. So I know this is a lot to take in, so let's walk through a very simple example to show how this works. Mount Pleasant Community Association, or MPCA, received $10,000 of contributions from a donor who specified that the contribution was to be used to construct a new playground. By the end of the year, MPCA had incurred $7,000 of construction costs for the playground. Assuming MPCA doesn't have any other contributions, how would this be recorded under the two methods? So here are the things that should pop out. The $10,000 has external restrictions from the donor, so we know that this amount should be restricted under both methods. And during the year, they spent $7,000 on the playground, which is in accordance with the donor's terms. So let's start by looking at the statement of operations under both methods. Under the restricted fund method, you'll note that we have three columns: a playground fund, a general fund, and a total. Here we would record the full $10,000 as revenue in the playground fund column. We can also record the $7,000 of costs that were spent on constructing the playground in the same column. So at the end of the period, we can see that there is $3,000 of money left over. Because everything was recorded in the playground fund column, we know the entire amount is supposed to be used for that purpose. Under the deferral method, we can only record the contribution to the extent that we've spent the funds on the playground. So in this example, we spent $7,000 constructing the playground, which gets recorded in expenses. That means we can also record $7,000 as revenue. Remember here, all funds are grouped together in the total column. So at the end of the period, this method is showing us that the association doesn't have any excess money remaining. But we know that there's $3,000 left over. So where does this get recorded? Let's flip over to the statement of financial position. Under the deferral method, we can see that the $3,000 shows up as a liability or a deferred contribution instead. So this lets the users of the financial statements know that while the association has $3,000 of cash, it also has an obligation of $3,000 that is being deferred for future use. You'll also note that there is nothing recorded under net assets because under the deferral method, the organization does not have any excess contributions. If we compare this to the restricted fund method, we can see that there is $3,000 of cash and $3,000 of net assets, so there are no liabilities. This method is showing that the association has $3,000 of excess contributions. However, that full amount is restricted within the playground fund. Remember that the basic rule of a balance sheet, or the statement of financial position, is that it should always balance, meaning that assets minus liabilities should equal net assets, which we see is the case in both methods here. So at the end of the day, both methods are telling us the same story, that the remaining $3,000 is to be used for the playground. It's just the presentation that is different. To conclude this section on reporting methods, here is a summary of considerations to keep in mind. First, the level or number of restricted contributions. Organizations that have very specific types of restrictions might choose the restricted fund method so that it can be more transparent with how they were using their funds. On the other hand, organizations that have minimal restrictions, especially from external donors, may prefer the deferral method. Second, consider the practicality of reporting in certain ways. To do so, consider what accounting system is available and what are the system's capabilities. If the organization wants to track everything in one fund, can they accurately track specific expenses against revenues to use the deferral method? And if an organization has hundreds of small contributions with various restrictions, can they practically track and report all of these as separate funds in the financial statements? Last, remember that the purpose of the financial statements is to tell the story of an organization. It's important to think about what the story the stakeholders and users would need to know in order to make decisions. One of the most difficult parts of being on a board is having to make decisions using imperfect information. Sometimes when you're handed a bunch of pages with numbers on it, it can be really difficult to see the big picture. In this next section, we'll walk through some of the tools that can be used to break down financial information in a meaningful way. Financial analysis, at its most basic form, is taking financial information and comparing it to other data points in order to assess performance and make decisions. Here are some common ways to do this. You can start by comparing the financial information between two different periods. Typically, this is done by comparing the current year to the prior year. This can be helpful because you can see whether the numbers have increased or decreased, which can potentially indicate changes in the business. As part of the oversight function, directors can add a lot of value by simply asking questions if they see unexpected changes. However, sometimes comparing to the prior year may not be the most reliable tool. This is especially the case if the strategic priorities for an organization are changing from one year to the next. Another tool is to compare actual results as presented in the financial statements to a budget. A budget is typically a plan that outlines the various activities or actions that are needed for an organization to undertake in order for it to achieve its goals in the future, typically looking at the next fiscal year. One of the key roles of the board is to review and approve the budget. As part of that review process, it's important that the board is not only making sure that it aligns with the organization's mission and strategic priorities, but also that the assumptions are realistic. So by comparing an organization's actual results to the budget, the board can assess whether the organization is performing better or worse than planned, which can help to identify problems earlier on and be more proactive. We spent a lot of time talking about donor contributions and the different ways an organization can report them. Nowadays, not-for-profits are being asked to be more transparent with how they're spending contributions from their donors. As a part of fulfilling its fiduciary duty, the board should play a role in monitoring restricted funds or defining a process to ensure that donors' funds are being used appropriately. A common way that a board can achieve this is by defining and monitoring key operating metrics, such as donor retention rates and operating cost metrics. Sometimes, these metrics are directly linked to an organization's mission. If we go back to the Calgary Zoo, for example, their mission is to become Canada's leader in wildlife conservation. And if you look at their annual report, they track how many baby animals were born during the year as part of their species survival plan. And because this metric is so integral to their mission, you can imagine that the board is tracking this year after year. When it comes to financial analysis, it's important to keep in mind that just looking at one of these areas in isolation won't give you the full picture. Using multiple tools in combination will give you a deeper understanding of an organization's overall financial health. A lot of financial analysis, like comparing to prior year or looking at key metrics, is centered around understanding historical data, being what happened in the past. Budgets, however, look at the future. It shows the direction of where management wants to take an organization based on its strategic goals. And because the board is ultimately responsible for providing strategic guidance, we're going to spend a bit more time looking at budgets in detail. In its most basic form, a budget is centered around three things: revenue, how an organization plans to make its money; expenses, how it plans to spend its money; and timing, being how those two activities line up. In many organizations, and especially in not-for-profits, budgets are an important tool for cash management. And for that reason, it's helpful for budgets to be prepared on a cash basis. You may be thinking, wait a minute, I thought accrual basis was best practice. For the financial statements, yes. The accrual basis shows a more accurate picture of what happened in the past. But again, budgets are focused on the future. And since not-for-profits aren't meant to generate a lot of excess cash or profits, it's really important to know how much cash runway an organization has to achieve its strategic plan. The cash basis can clearly illustrate this. Over the next few slides, we'll walk through an example budget to look at some of the key points from the lens of a board director. Specifically, does the budget reflect the direction that the organization wants to go? And does it reflect the strategic priorities that the board has helped to shape? Because the board doesn't typically prepare the budget, they can help provide an independent view as to whether the planned activities will achieve the goals and objectives of the organization. So here we have a budget that breaks down the planned revenues and expenses for an organization over a 12-month period. We can see that the organization anticipates its main sources of revenue will be a grant, ticket sales for a showcase event, and fees for virtual dance classes. We also see that the organization has planned for certain operating expenses like monthly rent and wages for dance instructors. In this example, a board might look at this and question whether these activities align with the organization's overall strategic direction. For example, if the organization's mission is to provide low-cost dance instruction and accessibility, are these choices aligned with that? It's important to remember, if the board has delegated decision-making authority to someone like the executive director, the intent of this review is not to replace and correct operational decisions. Rather, their goal is to examine and question those decisions to ensure that they are aligned. Because a budget can be based on a lot of future assumptions, best practice is to ask the preparer to outline those assumptions in a set of notes. That way, when the board is reviewing the budget, they can understand what has been and also, more importantly, what hasn't been considered. We've touched on this previously, but having enough resources is vital for an organization to be successful in achieving its strategy. So another key aspect to be looking at is how the planned activities impact the bottom line cash. In our example, a few things that might jump out would include things like periods that show negative cash. Here we can see that the cash balances go negative in May and June. A key question is, if the organization has no cash inflow during those months, how will it meet its obligations, like paying payroll or rent during this period? Another thing that impacts our cash is the timing of when cash comes in versus when payments are going out. In this budget, the main source of revenue is a grant in July, which is 6 months into the year. So something to consider here is whether the organization will have enough cash to operate up until they receive that grant. Something else that jumps out is the budgeted cash at the end of the year, about $3,000. While this is a positive number, we should question whether that will be enough to cover a few months of operating costs in the following year, especially if our main revenue source, like the grant, gets delayed or is lower than expected. So in a scenario like this, where an organization may be struggling with cash management, the board can provide some high-level direction to help mitigate risk. Sometimes, the board may be in a situation where a budget is overly optimistic, and if so, it's important to understand, discuss, and if need be, challenge the assumptions presented in the budget to ensure that things make sense. Sometimes, challenging assumptions can be a tricky discussion to navigate. One way to approach this is to ask the executive director how the budget would look if different assumptions were used. It's common for organizations to look at different scenarios, especially in times of uncertainty. Being able to see a best case, mid case, and worst case scenario is helpful to make a well-informed decision. While we just walked through a budget with a lot of detail, in reality, you may see a budget that looks more like this. This is a good opportunity to apply some of your knowledge. And so for this section, we'd encourage you to pause the video and think about what questions or concerns you might have as a director being asked to approve this budget. And when you're done, hit play and we'll talk through some of the things that we thought of. While this is a budget, a few questions that we would raise in reviewing a budget like this would be, first, does it give me enough information to make good, informed decisions? While I can see that the budget looks to be aligned with last year, is last year a good benchmark to be using? Do I have visibility as to whether the planned activities will reflect the organization's strategy for the next year? And do I have enough information to assess whether the assumptions behind the planned revenues and expenses are realistic? And if not, what kind of additional information would I need to get comfortable around these numbers? Second, while this budget shows that we'll have excess revenues over expenses, does this give me visibility into the actual cash implications on the organization? Does this consider the timing of cash inflows against cash outflows? And do I have to be concerned about running out of cash at any point during the year? Or if we start running into cash flow issues, is there a way to figure out whether certain expenses can be reduced or postponed? And what is our plan B if things don't go according to plan? I think the key takeaway is that a good budget helps make a board make well-informed decisions. It's important to raise these types of questions if you feel that you may not have the right information to do so.
I know we covered a lot of content today, but hopefully we can leave you with a few key takeaways before we wrap up. First, as a fiduciary, boards can help to protect an organization's assets through effective risk management and performance oversight. Second, good financial reporting helps to foster trust and support with stakeholders. Remember, the financial statements are meant to tell the story of an organization, and some methods of accounting will tell this story more accurately than others. And third, regular financial review is key. Even using basic tools like comparing a prior year or budget can help to identify whether an organization is meeting its objective. And lastly, financial language, like any language, can be learned. You don't have to be a financial expert to bring value to a board, but it is important to be able to recognize any warning signs within the financial information. Hopefully this course gave you some tools to do this more confidently.